Hello, my name is Daniel Medmody Ziegler. In today's video, I will be talking about Raytheon technologies. This is an assignment that I made in my class, Managerial Finance. This is a financial analysis, and this class is instructed by my professor, Dr. Corey Cole. So a little background, Raytheon was founded in 1922. It operates in multiple industries. So the aerospace, electronics, information, security, and defense industries. And as such, it has a very broad and wide product line. The company merged with United Technologies in 2020. As I mentioned earlier, the company, because it operates in multiple industries, it provides space technologies, airport safety measures, military systems, and more. And the stock price as of March 13th, 2021 is roughly $78. This is a nice video, short video that I would like to share with you. This is an overview and it just talks more about the company in roughly 1 to 1.5 minutes.
What if we just made spacesuits and outfitted almost every astronaut since Freedom 7? That'd be a big deal. What if we just invented modern aviation and made the most advanced engines in history? What if we just created missile defense and guidance systems used to protect the freedoms we hold dear? If we just did any one of those things, it'd be pretty special. But when the companies responsible for it all bring together bold leadership, we accomplish even more. Like building eco-aviation solutions, developing contactless airport technology, and creating real-time satellite imaging to enable instantaneous identification of assets on the ground. Nearly 200,000 employees working together to create safer, more connected flight, intelligent space systems, and smarter defense. And of course, we still make spacesuits. Raytheon Technologies, the future of aerospace and defense.
So if I may add my opinion, I think it is pretty impressive that the company operates in so many multiple and diverse industries. And each of these industry, I guess, requires a lot of responsibility. We're talking about really important and even sensitive products. But at the same time, it exposes the company to a greater risk, and I will talk about it shortly. As for the historical performance, this is the statement of operations or income statement 2017, 2019 on the right side. So I would like to point out a couple of points. Revenues increased by more than 28% in a span of 3 years. There was a larger expense in research and development, which is quite obvious. If the company has more revenues, then the company needs to invest more in research and development. The company is heavily dependent on research and development, as seen by the video. So over time, research and development activities went up. Operating profit increased by slightly more than 10% in 3 years. Tax rate is on average 32%. And lastly, net income increased by more than 20% in those 3 years. It looks pretty promising. As for the balance sheet, same pattern. However, less cash and equivalents in 2018 than in 2017, and less cash and equivalents in 2019 than in 2017. It was mostly due to heavy investing activities in 2018, so it does relate to the statement of cash flows. Basically, what happened is that the company, I guess the balance sheet and the statement of cash flow, they're pretty much tied up together. They show differences in accounts between current year or current period and a prior period. So if there were more investing activities in 2018, it does reflect on 2018 and 2019 performances. So I'll talk about it shortly, but it does suggest an expansion in these 2 years. The company's debt to asset ratio is between 67 to 69%. It means that the company uses debt financing more than equity financing. It may provide insights about the industry. It could be the case that these industries are more, I guess, safe. So you don't need to use as much equity financing, not a lot of default risk and all of that. And it could be the case that the company decides to use debt financing because it's cheaper. As for what I just mentioned before, there was larger investments in intangible assets and fixed assets in both 2018, 2019. It does suggest expansion and as such, more borrowings in these years. There was no preferred stock, but issuance of common stock grew in 2018, 2019 by a little bit. Treasury stock remained constant, so there was no excess repurchasing in 2017, 2018, and 2019. It means that the company was repurchasing at a constant, moderate, consistent rate, so no excess repurchasing. An overall increase in assets, liabilities, and equity, which usually it's a good sign. The company grows more, so it has more assets. And obviously, if the company has more assets, then it has more liabilities or equity or a combination of both. As for the statement of cash flows, so there was more income from continuing operations. There was a change in inventory that was significantly larger in 2018 than in both 2017, 2019. Again, suggests expansion in 2018 and does reflect on 2018 and 2019. And indeed, cash flows used in investing activities were noticeably larger in 2018. This figure, of course, all of these figures are in millions, so we can see that there was an increase of almost 17 million more in investing activities in 2018 compared to 2017 and 2019. This figure is roughly 450% larger. So it does suggest expansion again. It does suggest growth. And consequently, there was more issuance of long-term debt in 2018. As I said before, Raytheon uses debt financing. Dividend payments were moderately increasing. It does suggest that the company had more cash on hand to distribute to its shareholders after using retained earnings for growth activities. And there was a larger cash and equivalents in 2017 than in either 2018 or 2019. And 2019's ending cash and equivalents is larger than 2018's. Obviously, this is due to the fact that the company, I guess, heavily invested in investing activities in 2018. So it ended up 2018 with less cash and equivalents at the end of the year. And this is why 2019 started the year with less cash and equivalents on hand because of 2018 implications. This is the SWOT analysis, and I'll start from the strengths. So the company has good financial performances, nice or impressive ability to close deals. This is what I saw on the internet by reading news, press releases. So the company is able to close some pretty impressive deals that are valued at a quite large amount of dollars. We're talking about billions of dollars. So it is impressive. And obviously another strength is the engagement in research and development activities. As for the weaknesses, as I mentioned earlier, the company provides a very broad and large product line, and as such, it exposes the company to a greater risk because the company now needs to be responsible for more activities, for more products, for more services, for more support for its various and distinct products. And obviously, it does provide the company to a greater risk as opposed to, let's say, concentrating on 1, 2, or 3 products The company concentrates not only on various and distinct products, but on various and distinct industries. So it does expose the company to a greater risk. And additionally, there is a dependence on government contracts. So the company does depend on the government, how many contracts are offered, and so on. As for the opportunities, the company can always expand, acquire more companies, and also the company can improve its R&D activities. Basically, research and development activities are an ongoing activities. So there is always room for improvement and for becoming more efficient. And lastly, the company can innovate more systems and solutions. As technology becomes more advanced, the company can capitalize on this advantage and provide or manufacture or innovate more systems and solutions. So it is definitely an opportunity. And as for the threats, there is a fierce competition. So this industry has very big and large companies such as Boeing and GE, just to name a few. The company is exposed to lawsuits and regulations. Many people or other companies, competitors, or maybe the government can sue Raytheon if the company performs poorly. So there is a lot of responsibility in this business. As for the future assumptions, forecasting the future, so based on the company's historical performances, press releases, and news, the assumptions made are an overall improvement in most line items, more revenues, net income, and cash and equivalents. Debt to asset ratio will stay consistent around 65 to 70%, more investments in businesses and acquisitions, and same or more dependence on debt. So altogether, increased growth and improved performances in all financial statements. As for the pro forma financial statements, I would like to begin that there was a little difficulty in making this analysis because not only did the company merged with another company in 2020, but also there was the implications of COVID-19. So there was the questions of how to account and adjust for these two implications. So this analysis was in a way hybrid. I didn't want to disregard 2020 because it's an actual year and there was an actual performance in this year. But at the same time, it was an outlier because of COVID-19 and the merger year. So the decision was to incorporate 2020 figures when deemed necessary, when there was no other choice. For instance, for the cash flow statement or for the balance sheet, you need to use prior period. So I had to incorporate 2020. But when it wasn't necessary, I was trying to disregard 2020 and incorporate as many figures and assumptions as possible from 2017 throughout 2019. As for the income statement, so there was slightly lower revenues in 2021 throughout 2023 compared to 2019, but on average, this statement was better, I guess, than 2017, 2018. Again, it could be due to COVID-19, weaker years, so it does affect 2021 throughout 2023. It could be because of the merger, so in 2020, there were less sales than in the past 10 years, so it does affect the future. It could be many other things, but overall, there were slightly lower revenues in these 3 years. Research and development might be lower in 2021 due to COVID-19. Overall, higher net income in the future in 2021, 2023. So even though there were slightly lower revenues in these years, the net income was higher in these years. So there is an improvement, and there was more cash and equivalents in 2021, 2023. This is with regard to the balance sheet. There were more assets that could be converted into cash. And it is in line with the assumption because the company grows. the company expands, so there are more assets. And if there are more assets, there is more inventories, more accounts receivables, and more cash and equivalents that could be easily converted into cash. And consequently, as I said, increase in inventories, accounts receivables, borrowings, and more. So the continuation to it is that the debt to asset ratio remained consistent, roughly around 65 to 69%. No preferred stock issuance, a slight increase in common stock issuance. This again in line with the performance assumption, the historical performance assumption. Retained earnings will overall increase on average by more than 10% in 2021-2023 compared to 2017-2019. 2021, as I said, will be slightly weaker than 2019 and 2020. But only time will tell whether COVID-19 impacts were detrimental for the company's future or not. Right now, it's all pretty vague, and we will be able to see it when the company publishes and makes its financial reports for the future. And the same applies to the statement of cash flows. There was some actual values from 2020 that were integrated into the analysis. It did create a distortion because prior to 2020, the company had completely different financial statements. So in a way, it was kind of like making an analysis for two companies. So if you looked at the company's financial statements in 2020, and if you look at the company's financial statements in 2019, they belong to two different companies. In 2020, they belonged to Raytheon, and in 2019, they belonged to United Corporations, to United Technologies Corporations. So there was a lot of distortions between the figures. And obviously, adding to it the impacts of the virus, the statement of cash flow along with the balance sheet, they were slightly trickier and more complex to evaluate. As I said earlier, the statement of cash flow and the balance sheet, they are dependent on a relationship between a current and a prior period. So if you forecast the future, 2021, 2022, 2023, you have to incorporate 2020. But in 2020, there was a merger and COVID-19 prevailed. So how do you account for such a complication? How do you adjust for such a scenario? So it did create some distortion, but overall this analysis and everything that was computed and forecasted was in line with the assumptions as much as possible. Lastly, however, cash and equivalents are at the end of the period in line with the prior counterparts. So it does increase the confidence in this analysis. Raytheon will end with more cash on hands in 2021, 2022, 2023. These are the values, and they are in line with the prior values, even though I accounted for COVID-19 and the merger with United Technologies Corporation. So again, it does increase the confidence in the analysis in the end of the day. As for the intrinsic share price, I thought it was really interesting, and it does prove a point in finance. You have to be precise, you have to be accurate, you have to know what you do. Simply put, the original values before adjustments for the net operating working capital in 2022, 2023, they were approximately 29 million and 30 million. Now, for some reason, these two values resulted in a very skewed and off free cash flow growth rate, a negative one, which does not really make sense because none of the evaluation of the stock price made sense as a result. So in fact, because of these two figures, the 29 million and 30 million, figures were negative, and the stock price was significantly and extremely negative. So I think it is fascinating because by changing a MER of roughly $1 to $2 million in adjusting in adjusting net operating working capital in order to get a better, more realistic and positive growth rate, that I was able to derive a more representative and logical stock price. Obviously, I used net operating working capital and other measurements to derive the company's future cash flows, and then I discounted them to derive their present value, and then you find the value of operations. You divide it by the number of shares outstanding, and you get the intrinsic share value, the share price. So as I said before, just because I probably went on to be too pessimistic and my figures were just roughly lower by 1 or 2 million, the stock price was negative. So when I adjusted those figures and I just added 1 to 2 million and I improved the balance sheet a little bit, I improved the cash flow, the statement of cash flow a little bit, I was able to arrive at a better stock value. So the intrinsic share price ended with a stock price that is valued at a range of $25 to $40. And obviously, Raytheon Technologies merged in 2020. And at the time of the merger, the company's stock price was between $49 to $61. Now, IPOs are usually underpriced, and it does seem that reasonable that the company's stock price is currently trading at $75. So what happens is when those two companies merged, they in a way created a new entity. So these companies had been on before, and they had operations before, and everything was good. But when they merged, they in a way created a new entity. So it in a way kind of like similar to an IPO. And yeah, in April 2020, the stock price was lower. And now in March 2021, the stock price is valued higher. It's still not quite in line with my assumption, with my intrinsic share price, which ranges between $25 and $40. It could be the case that this analysis was pessimistic or that the company's stock value is overvalued. And also it could be because of COVID-19 implications. But the summary is that there is a need to account for COVID-19 and the merger. The company's past performances, they're pretty much satisfactory, and so is the forecast, the future forecast. Figures are overall in line, and most of line items and everything else is pretty much in line with the company's historical financial statements. So again, it is good, and it increases the confidence in this analysis. The end result is satisfactory. There might be a room for more optimistic adjustments, but I wanted to include COVID-19 and the merger. I wanted to incorporate them as much as possible. And maybe this is why some of the figures might be slightly weaker, might be too pessimistic, but I kind of like risk averse. So I would always like to have a margin of safety. But overall, Raytheon Technologies is a financially stable company, the one worth investing in and watching closely after. And this is all I have for this analysis. I hope you enjoyed and learned something new. Maybe you would buy Raytheon Technologies stock after watching this analysis. I would hope so. I actually bought one of their stocks. I really thank you for watching this video, and I appreciate you for watching this video. And thank you so much, Dr. Korikol, for all of your support and everything that you teach me. So thank you so much. Bye-bye.